Hey, my name is Randy Giveans, equity research analyst for shipping maritime at Jefferies. Today's panel, we have 5 of the top executives in one of the most exciting and definitely headline-worthy sectors right now, dry bulk shipping. So on today's panel, let's see how this, we have Mr. Gary Vogel, CEO and director of EGLE Bulk Shipping, John Wobensmith, CEO of Genco Shipping, Robert Bugbee, president of Scorpio Bulkers, Hajioannou, CEO of Safe Bulkers, and Tsantanis, chairman and CEO of Seanergy Maritime Holdings. So, over the past 12 months in dry bulk shipping, Charles Dickens put it best. It was the best of times, it was the worst of times. It was the spring of hope, it was the winter of despair. We had everything before us, we had nothing before. So, gentlemen, this room is filled with people looking for answers and curious about what is happening and what has happened to dry bulk shipping. So with that, let's dive in. Now, over the past 12 months or so, 24 months, you've seen a lot of volatility in rates, especially levels now being back to where they were kind of at early 2016, which was pretty much the bottom of the market. Cape-size rates having been hit the hardest, smaller asset classes also trading much lower. So this downtrend happened back in maybe December, well before Vale dam failures and other things. So John, we'll start with you if you can kind of give us a brief summary with what happened here over the past few months to push the rates so low.
Okay, well, I think I'll come back to this, but I think it's kind of hard to ignore the Vale situation being a black swan event. But if you take a step back and we look at fourth quarter of last year, which certainly did not materialize in the Cape-size sector as strong as everyone had hoped. I think the minor bulks actually performed pretty well. But we saw, because of where the price of iron ore, the high quality price of iron ore went, we saw inventory draws rather than imports in the fourth quarter. So rates actually wound up peaking last year more in the middle part of the year than what would be traditionally towards the end of the year. But I think what we're seeing right now in first quarter, I think you have to first, go with the normal assumption that we always see a slowdown in the first quarter because of weather issues. We don't see inventory restocking in the first quarter. We have Chinese New Year that typically shows a slowdown, and we have an increase in new building deliveries. So I think if you take all of that, putting Vale aside, that pushed rates down. Now, having said that, January actually held up pretty well. We were still at $14,000, $15,000 a day on average for Cape-size rates. And then unfortunately, I know you were looking for other events, but you can't ignore Vale. I mean, that was the black swan event, which has pushed rates down below $4,000 on Capes today. The good news is we've seen a rebound, which is very predictable and typical on the minor bulk side, as we've seen more Brazilian soybeans come into the market. We've seen coal shipments out of the U.S. resume going to India. So that part of the sector we actually see continuing to recover as we get into April and May. Sure.
All right, now there's been numerous periods of time where Panamaxes have outperformed Cape-sizes, such as the case is now. So can this last for more than a few months, or will Cape-sizes always outperform Panamaxes for any 6-month, 12-month time frame? So Polis, your company operates both Cape-sizes and Panamaxes, so I'll turn this one to you.
Yeah, in a normal market, we expect Cape-size to outperform Panamaxes by 50% at least. In a good market, could be double. Now we don't know. The first half of the year, I think that Panamaxes will be better than Cape-size. I see Cape-size recovering in the second half of the year. Ports will reopen and some of the output that was reduced will come back into the market. Of course, we have also some problems in Australia as well with this cyclone 2 weeks ago, 10 days ago, that Rio announced some reduction of output. Of course, this is increasing the prices, but with China issuing better news on its economy and on the PMIs, I heard today from some friends here, I haven't seen it. I'm optimistic that the demand will be there. So it's a matter if it's not done in the first half, it will be done on the second half. So I'm more optimistic on the second half than I used to be. Also, we know many ships will be in the yards fitting the scrubbers on the big ships. So I believe market should normalize in the second half for the big ships.
Okay. Now, currently, the time charter market is saying that spot rate weakness will last for maybe 1 to 3 years. As you can see here, time charter rates now at multi-year lows, still above kind of current spot rates. So, Gary, Eagle Bulk has some of its vessels on time charters, mostly on spot. What is your strategy for spot versus time charters in the coming quarters, and how or why do you make those chartering decisions?
Yes, so notwithstanding the current volatility, we're constructive on the market, particularly in the John mentioned the minor bulks, leading overall dry bulk demand, and we think supply is extremely interesting. Again, in our segment, we expect just over 2% net supply, fleet growth this year, and even better next year. So because of that, you know, we're not putting our ships out, and in general, we prefer to lock in revenue streams through using derivatives and contracts and maintaining the asset. Having said that, definitely with the volatility, as I've said many times, you know, it's a volatile industry. We do lock in cash flows at various times, and on our last earnings call, as an example, notwithstanding the fact that in February we were below 5,000, you know, the second half of this year was trading around 11. And as a company, we go out and lock in some cash flows through selling derivatives. And we never do that, we never take a naked derivative position to the market, but as a dynamic hedge. And when the market backs off right now, that second half of the market is below 10.5, we may buy it back. So it's more, we consider ourselves a spot trader with the goal of outperforming the index. At some point, when we're not constructive on further upside in the market, we may take more, you know, significant positions. But for now, we're a spot player, again, with a view to outperform.
Sure. Now, Robert, you had a lot of time charters to kind of get you through the normal seasonal weakness, as John was alluding to. Is that something that is going to unwind and spot for the rest of the year, or are you looking at more of some coverage now with the kind of current volatility?
They pretty well, most of them unwind pretty well by the middle of May. You know, traditionally we've always sought to cover the first quarter in some form or another. This year we put a higher percentage on, got lucky that way. There are in some cases, some pretty significant spreads right now of if you put ships out for 3-4 months. So we've put a couple of ships out, I think, for 3-4 months, way above whatever the indexes are showing right now. I'd agree with Gary that the actual market itself for the medium-sized, smaller-sized vessels that we have and Gary has is far more constructive than what these graphs imply. And in both cases, I mean, I would expect the actual results of the companies to come out ahead of where those indexes are for those medium, small ships.
Okay.
You know, and as to the future, I'd like to keep on, I think it's much easier to understand English literature, so if we can keep on that subject for the rest of the meeting, it'll be fine.
Okay. Charles Dickens?
Good.
Yeah. Sure. So yes, focusing on dry bulk shipping demand, the black swan, as John alluded to here. So tragic incident, Vale Dam collapse earlier this year has led to a large disruption in iron ore mining in Brazil, iron ore exports out of the country. You know, nearly 93 million tons of Vale's capacity has been disrupted. Vale recently lowered its 2019 iron ore sales guidance by 50 to 75 million tons. So Stamatis, as a pure play Capesize owner, what do you see as a catalyst to boost Capesize rates in the interim, or is it so goes Vale, so goes the Capesize market?
Well, thank you. First of all, it's very sad that another safety incident happened in Brazil with a severe loss of life. This is the third time that this is happening. You had Samarco a few years ago. Now this is, of course, a very tragic event, but let us not forget the Stella Daisy incident that was also a Vale chartered ship that was carrying iron ore on a very, very old converted VLOC. So it's very unfortunate, and I think that safety and loss of life should be the top priority, you know, in Brazil. And that being said, yes, of course, you need to make the dams safer. These are basically dams that were constructed like 40 or 50 years ago from German miner at the time. So, you know, this is very tragic, but the problem now is that what's going to happen with the actual ships that are transporting the iron ore? All these converted VLOCs, they need to exit the market at a certain point because, yes, okay, you have an incident in Brazil, but at the same time you have many ticking time bombs in the seas where, you know, human lives are being lost. So that needs to change, and that is going to be a very helpful factor for safety, of course, but also for the rates. Now, about Brazil, I think that currently we're going through the worst possible phase where about 100 million tons of iron ore are being stopped from production. If you, I don't know who read the Vale's earnings release a few days ago, but Vale made $40 of EBITDA per exported ton in 2018 at approximately $18 per ton of transported cost. So, you know, that's a very helpful number to show you that for every ton lost from Brazil, there is a very heavy loss of revenues for the country. Vale is basically a state-owned company, and at a certain point, they need to reopen the exports and they need to restart the production as quickly as possible because they're losing hundreds of millions, if not billions of dollars. So we're confident that sooner rather than later this is going to start, and we also think that in the second half of the year, this is going to become a reality.
Thanks. All right, John, continuing on the iron ore theme, what is your outlook for Chinese iron ore imports? Will Australia be able to offset a lot of that Brazilian production, or will they just continue to kind of draw down inventories going forward?
I think it's going to be a little bit of both. I mean, I think if you look at where you can potentially have increased exports, you probably have maybe 20 to 25 million tons out of Australia. Unfortunately, that is a short haul trade, so it's certainly not going to make up for the ton miles lost coming out of Brazil. On the Brazilian front, you have Anglo-American that's going to be up to 15 to 18 million tons of additional long-haul trade. That will be somewhat helpful. I still think there's a question on the Vale front, how quickly they can get the Brucutu mine up and running, which is 30 million tons. Hopefully that will happen this year. I agree with Paulus. We're more constructive on the second half of the year than we are on the first half, both from a seasonality standpoint, and I do think there will be some more clarity from Vale in terms of getting Brucutu up and running and probably shifting more production up to S11D. Having said that, I'm not overly optimistic in terms of the Brazilian iron ore trade this year, and I do think there also could be some additional volumes out of Canada. And hopefully, as Stamatis was pointing out, we see some of these VLOCs continue to be scrapped. We've seen, I think, 3 so far this year, and Capesize scrapping in general has picked up. So as we get into the latter part of the year, I'm, again, a little more constructive, though I can tell you right now, I'm already looking forward to 2020, where we should have, again, a very low growth on the supply side, and we should be back into the positive on iron ore growth.
Sure. All right, Robert, how meaningful will Chinese and Indian coal imports be to increase dry bulk shipping demand? You know, inventories remain relatively depleted. China seems to be turning away from coal. India continues to push the private sector coal mining. So can you touch on the coal demand?
Yeah, I mean, they're going to be meaningful as an extra cargo. And, but I think that, you know, we have to be a little bit careful as, yes, India is doing great as far as potential demand is going to come. You know, China, you know, we have to watch a little bit in terms of that. I mean, coal in that area, the part of it for the energy is going to compete with LNG. That's going to be nicely priced there, etc. But I think that for us and companies like ours, you know, Gary's company, etc., that have these, you know, smaller vessels that are really far more diversified. I think we've had a lot of good news actually come into the markets in the last couple of months. I mean, it would appear as if the US and China are going to get some form of trade agreement together. It's clear that, you know, we felt all along that whether we look at the product markets, the crude markets, and our dry markets, that the Chinese economy, you know, may have slowed its growth on a historical basis, but it's still growing and still growing quite actively, and the surrounding areas of China as importantly, including India, are, really doing very well. So I don't think that there's a lot to look forward to in those small and medium-sized vessels, especially if we have a trade agreement.
Sure.
So I know the focus, as usual, is on, on these bigger ships, but they're two different worlds right now. As Gary pointed out, the supply side on the small ships looks great. The demand side looks very favorable. There are no issues. It's very different to if you're sitting as a Cape owner right now.
Sure. Good segue there, I guess. Gary, obviously most of the focus has been on iron ore and coal. What is your outlook for kind of the minor bulk, especially grain, soybean trades, and how has the U.S.-China trade tensions impacted that soybean trade?
Yeah, so I think, first of all, it's definitely affected it. China's soybean imports last year were down around 8 million tons overall, but we saw U.S. exports were down 17 million tons, and so we saw Brazil shift selling more product to China, and then the U.S. backfilled to places, primarily Europe, more short haul. And so while overall, from a number standpoint, 8 million isn't huge. We're talking about a market that was growing on an annualized basis since 2012 at around 10%. So we went from significant growth, leading grain, shipping to a drag. And then the other thing that happened, and this was part of that confluence of events that happened in fourth quarter, was that Brazilian beans tend to start moving around March. And usually end midsummer. They definitely continued longer than that because of the sales into China. And then in fourth quarter, the U.S., that long haul trade was just missing. So it was that confluence of lack of soybean trade in the U.S. plus a pullback in coal and the other seasonal effects that we talked about that really led to that decline on the smaller mid-sized segment as well. The difference is we had a quick rebound come kind of early February around when Chinese New Year was over. So we think that grain is coming back, is going to come back and be very positive this year. Whereas last year it was just a little bit better than 0%. But clearly a deal with China and the U.S. will be very helpful. There's a significant amount of soybeans that could be released, and that would definitely be positive. But even without that, we have Brazil coming on stream now, and there's been an early harvest, so we're positive about that development as well.
Okay. Now switching gears to dry bulk shipping supply, starting with your respective fleets. Recent years, dry bulk companies have tended to focus on either the larger or the smaller, as a lot of you were alluding to. Now, Seanergy obviously owning only Cape sizes. So Stamatis, what are the pros and cons to fleet specialization?
Well, for us, at the end of the day, dry bulk is dry bulk, and yes, sometimes Cape sizes perform, well, most of the times, Cape sizes perform better than the other sectors, and they indeed are dependent on fewer cargoes and fewer countries. But at the end of the day, if the Cape size suffer, then that eventually has a cascading effect on the rest of the dry bulk. So as far as we're concerned, we're a company that has only about 10 years of life. We cannot, and I don't think that any company can say that can offer any real added value operating smaller ships. I mean, there are like hundreds of companies operating Supramaxes, Handymaxes, Kamsarmax and Panamaxes, but the last 10 years, and especially the last 5, we have focused in the operation, commercial management, and technical management of the Capes. And we have invested all of our resources there, not only financially, but also, commercial and operational, which, of course, at the end of the day, this is what counts, when you're in a shipping company. So for us, it's very important to continue that, and we continue to see the fundamentals of the Cape size market being the most favorable among the other sectors, of course, black swan factors aside.
Sorry, can I just comment, because I just have to disagree that you can't, the comment that you can't add value, over and above, particularly on the smaller sizes. It's a much more opaque market. I mentioned the use of derivatives, contracts. Last year we called on 450 ports, and so we are able to, through various means, arbitrage, and I won't spend all the time here, outperform, and we have now for 8 quarters in a row, which we benchmark our performance. So I do not disagree that on the larger sizes, much more difficult, much more transparent market, fewer trade routes, but absolutely active owner operating can create real value over and above index returns.
Okay.
Thanks for that.
Yep. So now there are more than, let's see, we're going the wrong way. More than 200 new building Cape-size Newcastle Max, Valley Maxes on the order book, 23 different shipyards. So, John, any interest in renewing your fleet via some new buildings, or are you solely looking at second hands? And if looking at new buildings, if you ordered it today, when could you get that delivered?
Well, okay, first of all, no on new buildings. Let's be very clear.
No on new
Everybody
buildings.
on this panel shares my, my view on that. Look, I mean, today you're really talking about a 2021 delivery if you were to order, which I would recommend highly against anyone ordering ships today. I would, just to go back real quick to your previous question, though, I would like to, the concept of large ships versus small ships. At Genco, we've actually taken a barbell approach to this. We have more than half of our ships are actually on the minor bulks, so the Ultramaxes all the way down to the handy size, and then we also have the exposure on the Cape size. The way we view it is from both a commercial standpoint. We can add a lot of value on the minor bulks with our new commercial platform, and we did in 2018. We beat the market by $600 a day on the minor bulks. That provides us with a fairly stable income stream. We almost look at that as the ability to cover our commercial bank financing, whereas we also think it's very important, particularly in the capital markets, to have that high beta, that upside potential on the Capes. And I think if you look at the stocks that have the Cape size exposure, while they may not look that great right now from a valuation standpoint, the reality is those stocks have shot up because of that Cape size volatility, where the companies that are really just focused on some of the smaller sizes go from here to here. There's just very little volatility. So if you want to play the cycle, I think you have to have the larger ships in your portfolio. Having said that, we like the direct exposure of iron ore all the way down to the minor bulks with a mixed fleet.
Now, during a slight charter rate recovery, new build ordering was substantial in 2013 and 14. During the spot rate downturn in 15 and 16, slowed pretty significantly. So with that, new building has grown meaningfully over the past 2 years. And so, Robert, what has caused or allowed for this recent ordering resurgence? Is financing that easily available? I know you've been pretty active in the sale and leaseback market, so I'll let you start.
I think you should go back to the previous slide.
Okay.
The new building and ordering is really only happening in, this is a very generous slide to the Cape-size Newcastle Max and Valley Max owners, because the size of vessel being ordered in 2009 to 2012 is much smaller than the size of vessel being ordered from 18, 19, and 20 here. And I think Gary is 100% right that you've got a greater chance of outperforming an index in the smaller vessels than you have in the larger vessels, and it really is bifurcated. So for want of a better phrase, the sex appeal historically was all those Cape-size vessels, and the markets did go up, and stocks did go up on anticipation of great beta and great volatility as the Cape-size market moved out. And that then resulted in a series of orders. Even the market just forgot about 2016 pretty quickly and started ordering ships. And they started ordering bigger and bigger ships. So one of the other factors here is you have a real bifurcated market on supply. There hasn't been that much ordering of new Ultramaxes and Supramaxes.
All right, looking at the opposite end of fleet.
Go
ahead, Stamatis.
I kind of disagree with that. I mean, right now you have 260 Ultramaxes on order for 19 and 20 deliveries, and you have altogether about 300 Kamsarmaxes and Panamaxes to be delivered in 19 and 20. So the total combined is 550 ships that are going to be delivered in 19 and 20.
But ships isn't the measurement that should be used. The measurement that should be used is deadweight over deadweight in each category, not number of ships in each category, because the number of ships when you put the invention of Valley Maxes and Newcastle Maxes and put it on a Cape-size position, those ships are much, much bigger.
That's actually not the correct point, because on total, you have for Valley Maxes and Cape sizes, 56 million deadweight tons on order, while you have 46 million deadweight tons that are 2002, 2003, and older than that. So, you know, the new building, all this new building spree on all this uneconomical, and I'm not sure whether all these contracts, now that Vale has $5 billion of cash tied up with various things, I'm not sure whether Vale will be able to perform on all these contracts, but assuming that they do, you know, it's 56 versus 46 that needs to be scrapped. It's the floating.
I think the point is that the moderator was trying to talk about was the different sectors of the positions. And on the one side, in the smaller vessels, you have a highly diversified demand side that is clearly growing, that you're not dependent on one trade, one commodity, or a couple of countries and a couple of trade routes where it is possible. And here, you know, here I will use Gary and EGLE as the proof here, rather than talk our own book. That is very clear that a company that is able to operate and manage fleet, et cetera, is able to outperform the index. And I would expect that to continue in a consistent manner, as opposed to, and has a new building order book going forwards that isn't that much of the total supply position. And you have another one at the moment that is dependent upon, you know, one country in demand, China, two supply areas, Australia and Brazil. Basically, it depends on one commodity to function. That commodity and that trade right now is in a lot of trouble, and it unfortunately is happening into the teeth of a delivery schedule that's coming that was formed off the back of the optimism in 16 and 17. So I simply think that the smaller vessels are going to be outperforming those larger vessels.
That's good. We'll come back to this debate at the end. Polis, I promise we will. Looking at the opposite of fleet growth, scrapping has averaged about 26 million deadweight tons per year from 2011 to 16. 30 million deadweight tons were scrapped in 2016. Obviously in 2017, they got cut in half to 15 million deadweight tons. 2018, basically a record low, or at least since 2007, of 4 million deadweight tons. This year's picked up a little bit, but what is kind of your scrapping assumption for 2019, 2020, looking at where rates are, looking at steel prices, looking at ballast water treatment, IMO 2020, all the above?
Yes, I think scrapping is the big factor that will help the market at the end of the day. And I tend to agree with the prospect of the Cape-size market that is far brighter as far as scrapping is concerned. The fleet is older on the Cape-size, I will agree to that, it's a very fair comment. Traditionally, over the years, the big ships are the ones that made the big money. And they are, of course, they are very volatile. When the market is not good, they suffer a lot. So companies who opted to order smaller ships over the years, they did it more for safety reasons, you know. It's a little bit more speculative game on the Cape-size market because it's mainly one commodity, 80% one commodity, 20% the coal business. And it's either you make a fortune or you lose a lot of money. But if you are losing a lot of money, the more you lose, the faster the market will correct because of the older ships going for scrap. I'm hearing traditional Greek ship owners scrapping now Cape sizes of 2000, 2001 built ahead of time, simply because at 17 and a half years old, you have to pass intermediate survey, which is like special survey at this age. You had to fit the ballast water treatment plan, and you have to face with an uneconomical ship the IMO new regulation on sulfur cap, which means you have to burn more expensive oil on a heavy consumption vessel. So I tend to agree with Stamatis that Cape size will have a very good future. Maybe they are suffering now, but as soon as these problems out of Brazil are sorted out in the second half of the year, with so many Capes in the yards fitting scrubbers, the younger Capes, and some of the older ones have to be scrapped because of all these regulations, I think that the Capes will recover meaningfully in the second half, and we'll see better market in 20 and 21. Generally, I'm optimistic about the market because also the trade war should stabilize or finish at a certain part. We have elections in the US next October. Surely Mr. Trump wants to be re-elected, and surely he has to get the economy going again. Interest rates have come down and will keep under control. No hikes for 2019 are expected by the majority of banks. This will extend the business cycle. It will not finish in 2021. It could go another 1 or 2 years longer. This gives me reasons for optimism. If we didn't have, as John said, the Chinese New Year, the new buildings, plus the Valley effect this year, I wouldn't see why Capesize wouldn't have been in April or May at $20,000 a day in the spot market. They could easily go there in a matter of weeks. I think the scrapping will be bigger on the Capesize, and this will save the day at the end of the day.
Perfect. All right, let's jump to IMO 2020. So with that, all of you are installing scrubbers, some of it, all of your fleet, some of it, a few vessels on your fleet. So John, if you want to kind of start, last year you maybe questioned a little bit the availability of HSFO at smaller ports, had at this point last year had no vessels, no scrubbers ordered. Now you're putting scrubbers on all of your Cape sizes, but not your smaller vessels. So if you want to touch on some of that kind of strategy and maybe HSFO fuel availability, your thought process between the HSFO, VLSFO trade, the spread. A lot of questions. Go for it.
Okay, I'll take some of it because I'm sure these guys want to say as well. But so yes, we are putting scrubbers on our 17 Cape size. We are, at least at this point, not putting it on the smaller ships. And the reason is simple. When we look at the payback period on a Cape-size vessel, it's about a year, basis a $200 fuel spread. To us, that's a very good hedge, because our 17 Capes make up about 40% of our total fuel over a year time period. On the smaller ships, based on a $200 spread, depending on trading patterns, you have payback periods of anywhere from 3 to 4 years. And as we looked at it, we just felt that was a little too long. We still think there are a lot of questions on what the spread is going to be. I think in terms of availability of fuel, certainly the large ports will have HSFO available. And I don't have an answer on the smaller ports yet. I still think we're a quarter or two away from knowing what each individual port is really going to do. And I will also say, we're doing it on the Capes, and from an environmental standpoint, we actually think installing scrubbers on ships, from an air pollution standpoint, is a much better solution than even burning compliant fuel. But unfortunately, on the smaller ships, we couldn't get quite comfortable with the longer payback period.
Sure. Robert, you're putting scrubbers on all of your vessels, or I guess all of your owned Scorpio bulkers, Ultramaxes, Kamsarmax. I guess give the other side of the debate there. John says no on the smaller ones. You're putting them on all of them.
Well, we have the option to put it on all of our ships. And to be exact, that's not fully decided, but we will anyway, have some on some of the smaller ones, regardless of what happens. But I think it's a question of optionality. I mean, we see all these customers. We see all the product tanker refiners from the Scorpio tanker side, because Scorpio Tankers is the largest product tanker owner in the world. And all we really know is there's going to be chaos ahead, real chaos. I mean, already those customers, when they talk to us on contracts in the tanker side, are indicating that they're not even sure about how we're going to do this, et cetera, that the whole thing is a big game of, wait and see poker at the moment, because it costs more to refine the low sulfur fuel. And while people at the moment aren't buying it because they don't need to use it, you don't really want to refine a whole bunch of this stuff today and just keep it in storage somewhere and pay high storage costs. So everybody's going to try and game this and leave it as last minute before they start taking and transporting this low sulfur fuel around the world to these multiple ports that there are. And if you just think about what you've heard today, I think Gary, you know, correct me if I'm wrong, you said you went to 450 ports last year. There's 450 ports that are going to need some capability of bunkering just there. So the whole idea is, I think the paybacks in the scrubbers are probably underestimated because the spreads are going to be wider than what people think, because there's really no buyer of the heavy fuel. It's got to go down and compete not just with coal but LNG if you're going to use it for electric to start with. And then there's going to be areas where you're going to have mismatches of probably the high sulfur fuel. That some of these places may actually have run low on that fuel, so you may have waiting days for ships to fill up with the high sulfur fuel. Right. So to us, the scrubber part is an option.
In 1 minute, Gary, if you can kind of touch on that as well, and also your at-sea installation process.
Yeah. Oh, in 1 minute. Okay. Yeah, I mean, first of all, I think I understand why you, in isolation, say I'll put it on a Cape-size vessel burns more fuel. Installation cost is a bit more, but I understand that. But what's interesting dynamic is that in the mid-size segment, we expect less than 10% penetration. So the competition between Cape-size ships will be almost non-existent. And you have the opportunity to trade the vessels, especially as an active owner-operator, on trade routes where they spend more time at sea. It's not the average, it's what you do with that ship given. So once you have a scrubber-fitted vessel, you'll trade around the main bunkering ports in terms of availability. Sure, I don't believe heavy fuel will be available at a lot of the smaller ports we go to, but those scrubber-fitted ships will naturally go towards areas where there won't be deviation, where they won't have to carry additional cargo. So there's a lot of application once there's a scrubber on a ship. And again, I think that low penetration is really interesting. In terms of the at-sea installation, I mean, it was simply a calculation that spending roughly half the time in port to install a scrubber, and then there's additional cost. We have 8 people on a riding team that go on. Effectively, the ship comes in, we have prefabricated a funnel and scrubber, cut off the old funnel, lift on the new one, cut a sea chest, and then the ship sails out with 8 people who effectively connect all the equipment over the next number of weeks, and then the ship gets commissioned. Clearly, there's additional costs with that, and some of it comes down to what is the savings in off-hire time relative to the incremental cost. That's the calculus behind it, and so that's in 1 minute.
Perfect. All right, last question. I'm going to let everyone answer. So, if I, unfortunately not me, but maybe an investor, gave you $50 million in cash, what would you do with it today? You had to spend it today. You have 4 options. Buy vessels, order scrubbers, pay down debt, repurchase shares. So I'm going to start with Polis and come all the way this way. Robert, I'm giving you extra time so you don't say Scorpio tankers. So starting with Polis, one of those 4 options, $50 million. Go.
I think more scrubbers.
More scrubbers. Love the sensitivity of it.
A combination of buying more capes at these levels now that the values are going down, plus, of course, deleveraging a little bit.
Deleveraging capes. Go.
Well, if you're just handing me $50 million, I would probably go and buy most of these companies up here. All these companies are trading at a massive discount to NAV, and I know we're running out of time, but the reality is we are now in a situation where Vale has quantified what the issue is, right? All of that is now priced into these stocks. They're all trading terribly, in my view, from a valuation standpoint. So I think there's some very compelling values. And the way I look at this now, the downside's in. There's only upside. I mean, when you have capes at $3,000 a day, sure, they can go to 1,000, but they can't go much lower. So there's only upside, and I'd probably buy almost all these stocks on the panel.
Excellent.
Well, before John bought us, I'd go out and order more scrubbers. We've already ordered 37, but I think one caveat is to have them installed by January 1st, 2020, when we believe the fuel spreads and the volatility will be greatest.
Okay, Robert, one of the 4 options.
Well, we've cut them down so much now because we've already got the scrubbers.
Okay.
We're already the largest holder of Scorpio tankers. So I guess buying our own stock is what's left.
There you go, buying stock. Awesome. All right, well, that's it for me. Thank you all again.
All right.
Pass home. Yep, absolutely, yeah. So scrubber questions, pull this, for example. You know, you're putting them on most of your larger vessels, not all. If you want to give a little 2-minute kind of strategy for why you're doing that. And you just said you'd put more scrubbers on if you had $50 million more.
Yes. First of all, we took the decision according to the liquidity we had in the company last year. So we had a good market last year. We made a good profit last year. And after 3 terrible years. So we thought that we can easily afford, without taking much finance, to install about half the fleet. Obviously, the easy part is you go on the post-Panamaxes that they burn 28, 29 tons a day, instead of going to the Eco Panamaxes, which burn 10 tons less. So that was the simple mathematics, and also we avoid installing on the ships that they were approaching 15 years old, because you have less time to make something out of it. I'm very optimistic that it will work nicely for all the type of vessels, the scrubber, because whether it's only 20%, 30% of capes that they are installing it, you will compete with 30% of the market. That's all. On the smaller sizes, even better, you compete with the 5% of the market. But on the capes, I think is a better prospect with the scrubber cape, because the 30% of the market that will have scrubber will create a market of its own. So you will be competing in a market that will be a real market. In our sizes, it will be a little bit more difficult, because the 95% of the ships, they will not have scrubbers. So we will have to convince the other side, and obviously the other side, they will try to get a cut into the scrubber benefit. So there, of course, a company should elect to work the vessels in the spot market, preferably on voyage basis, where the owner can get the 100% of the benefit and not share it with people who haven't invested in it. So I think that companies who moved early, and mostly it was listed companies, they were brave and they did the right thing. It is a regulation that we all knew it would come into 2020. We knew it since 10 years ago. Nobody acted on it, simply because I think we were busy with other things, and also the scrubbers were very expensive. In 2018, the prices of scrubbers started coming off, became more reasonable. People are complaining now about environment. We are hearing companies that all their life they were not very friendly to the environment. They had older ships. They have suddenly become ultra sensitive about open loop scrubbers for something that nobody yet knows if there is any effect or not. The IMO has approved this type of scrubbers. Let them work, and we see in 5, 6 years if this scrubber should be withdrawn and replaced with something else. You know, I mean that when the full analysis and all the data are known, 3, 4 years down the road, we'll see what happens next. But overall, I'm very optimistic about this regulation.
Stamatis, quickly to you. You have 10 cape sizes, 5 on charter, 5 on spot. The 5 on charter, you're putting scrubbers on. Was that you pursuing the charterer? Were they asking you for that? Kind of discuss your strategy.
Well, it is, of course, a liquidity, a very heavy investment to install the scrubbers. And given that the market today is at $3,500 a day, I think it's kind of surreal to have this discussion about premium and all that. Yes, you may have a couple of thousand more, but this has been untested. So as a company, we decided to take a more innovative approach. We did it in cooperation with a charter, so we are not paying for the scrubbers, we are not paying for the installation, and we're not paying, for the equipment, and we're actually getting reimbursed of the off-hire period. So we decided on the ships, on 50% of the fleet, that we will install the scrubbers, not to pay for the scrubbers. So, and on top of that, we also have a profit-sharing element. So above a certain spread level, we're getting a profit back. So this is the kind of approach that Seanergy took on that.
Excellent. Robert has done 10
I think the most simplest thing here is if you had a whole bunch of customers up here, the customers would tell you they just prefer ships with scrubbers. I mean, they're willing to pay for it. They're willing to pay for it in tankers, they're willing to pay for it in product tankers, and they're willing to pay for it already in dry bulk.
Excellent.